Welcome to another episode of Rich Dad Stockcast, where we're here to help people who are serious about improving their financial education. I'm your host, Denney, and today we have an important topic: the fundamentals of value investing, how to build a monthly cash flow machine. As we get started, remember to like, subscribe, and leave your comments below. Your feedback helps us to bring you more of the content that you want to hear. Don't forget to visit stockcastbonus.com for free access to valuable educational resources to boost your financial knowledge. Rich Dad expert Andy Tanner is joining us today. Andy, welcome back to the show.
Tell man, it's good to see you. It's good to be with you. This topic is like right in my wheelhouse. I love this topic. And so can't wait to dive in, man. This is going to be a good one.
Me too. So let's just dive into this. So there's so many things that we could do in investing and value investing. Let's just start off with the basics. Can you explain the key principles of value investing? Like, what foundational concepts should every investor understand?
So let's just talk about what it is, right? And people have value all the time. A great way to define a transaction is price is what you pay and value is what you receive. And so when we talk about value investing, we're talking about finding assets that are worth far, 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 far more than we would ever pay for them. In other words, their prices are very, very low, and the value that you get is very, very high. A great way is we're going to get bargains. And value investing is about finding bargains. And it's exciting. Most people that shop, they can't wait for Black Friday because it's bargains, or they brag, hey, I got this bargain, or I got this on sale, I got this 2-for-1, or, this guy sold his, thing in the local paper, or I got this bargain on eBay. Value investing is the same thing. It's when we're shopping, literally, we are shopping for stuff that is way, 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 way valuable, and the price is just irresistible. So that's what value investing is when we find great, great bargains.
So how do we know when we find a great bargain? There's all, I think about my wife going on sale, there's always a bargain, if you will, right? There's always,
the markup before the markdown, right? They mark it up before they mark it down.
Exactly.
They call that phantom pricing. Well, it's funny. These are not fungible assets, meaning they're not transferable. Fungible means this. Let's say I go, yesterday, my wife made some incredibly homemade bread. She loves, that type of, she likes to get in the kitchen and make a treat for her boys. And we made these grilled cheese sandwiches, and I love to dip it in tomato soup. So when I go to the store and there's all the cans of tomato soup, how do you tell which one's the best can? You can't. They're all the same, right? So it's kind of like your question, like, stocks are stocks. How do I tell, right? How do I tell one from the other? One can, it's all Campbell's soup or whatever, Chunky or whatever brand you're going after. So, but produce is different. I literally will compare apples to apples. I love the Honeycrisp and the Fuji's. And so I'll go and I'll look at the Fuji's, and some of them are a little more ripe than the others. One might be more crisp, one might be soft. When I get watermelon, which I love, I have the talent, man. I thump that thing and I feel that vibration on the other side. I'm going to get the very best one. And the way you do it is by comparison. I will look at one stock and I learn how to compare it to the other, and I'll say, my gosh, this one is performing better than this one, but look at the price. I'll give you an example. We'll do some fancy jargon. When I buy a company, I'm buying the financial statement, right? All the assets are now mine, or a share of them, and all the liabilities are now mine, a share of them. So we have these things called price ratios. And so, for example, price to book means how much am I spending for this balance sheet? Price to earnings, how much am I spending for these profits? Price to sales, how much am I spending? So price is what I'm sending out, but only with those ratios do I really reveal what I'm getting, right? price to book. That's how much this money's in the company, right? I get all their loan payments, but I also get all their assets, right? Assets and liabilities. Price to revenue. Oh, I see price to sales. I see how many sales I'm getting now as a business owner. What am I paying for that? So when you start to learn that jargon and learn those ratios, I can compare apples to apples, and I say, well, my gosh, the average price to book in, say, a sector is X, but this particular company is so much better than that. And then I got to ask myself, why is this on sale? Why is this so good? But that starts the bargain. That's the same as shopping, right? Okay, well, why is this guy selling this car for so low? Is there something wrong with it? And you start that detective work. So the way to tell when something's on sale is when the price is extraordinarily low, and its numbers are comparatively good or better than maybe the average in that industry. The average, boy, look at this watermelon. This one's like better than, boy, I thumped this one. This one's like way good, right? And that's how it's done, is by comparison.
That's I love that analogy. Now that we understand, what value investing is, why value investing? Like, what's the benefits of it? We understand that, we want to get a good deal, whether it's apples to apples or whatever it might be. But why this strategy as opposed to maybe others that are out there?
Well, let's compare apples to apple or apples to oranges here. Other strategies would be, chasing prices. In other words, if you have an algorithm and it's just looking at stock chart patterns, it may totally discount. It's absolutely possible. It might not even look at what the business sells or what it does. We're just looking at price action on a price chart, and we're chasing shiny objects. I'll tell you what, this happened to NVIDIA. NVIDIA explodes and people get excited, and so they buy it after the price is already high. And so, if you don't understand that you're buying a business, you wind up chasing a chart, and you wind up paying more for what you're getting. So now you're paying something that's overpriced, right, with little value, where the money that you're spending out is much, much larger than the value. And if I might add to that, 401ks right now are kind of a mess, because think about this, Dell. Let's look at the 401k strategy as opposed to a value investor. What a 401k does is I'm on autopilot, especially in my home country, the United States, but we have listeners in Australia that have the super. We have listeners in Canada that have the RRSP. We have listeners in Japan, and they called theirs 401k and copied us. But there is no value prospect in a 401k. I'm on autopilot. We're not scrutinizing anything. We're just going to the grocery store and say, load up the cart with whatever it is. It's almost as if I call the grocery store to buy my produce. Say, hey, just send me whatever and give me a nice diversified, basket of vegetables. They're not going to take that and really compare and thump those watermelons. They're going to go get a watermelon for me. And they might not even, do a good job there. So let's say prices are extraordinarily high and markets are really excited. And so prices are higher than they should be. Well, now a 401k is getting less asset, because think about it. Let's say you put $1,000 a month in your 401k, 1,000 or whatever you get, 500, 300, whatever goes in there. You're just buying the market generalized, and you're buying it today at the highest prices that it's ever been. We're flirting with all-time highs. We pulled back a little off the all-time highs. We're basically at all-time highs. So that means that if you had that $1,000 2 years ago, you'd buy twice as much Apple with that $1,000. Now you're getting half the shares. You're getting half as much asset because you're paying so much. And there's no scrutiny there. You don't know whether you're getting a value or not. You don't know if you're overpriced. So the reason value investing is an important skill is you're approaching this as a business owner, not a stock trader. And you're approaching this as someone who wants a bargain rather than the autopilot. You see, when we compare these two strategies side by side, how nutty it would be to just throw money arbitrarily or haphazardly into a 401k, paying whatever. There's a Shiller PE index that basically says how much do the companies in the S&P 500 make? What are their earnings? And it averages them together. And it says, what are we paying? How much price are you paying? That's what you send out for earnings that you get. I have a cash flow jack in the box. Can't reach it, it's too far away, but it's up there. And the cash flow jack in the box, picture that. It's a crank that does work and it gives me cash. How much are you going to pay for that cash machine? Well, the Schiller PE, it's almost at its all-time highs. We're paying more money for less shares and more money for less earnings than ever before. So this value investing thing, if you're into financial education, learn it and learn those ratios and learn the jargon and get to class with us and learn how to do it.
Amen to that. Now, as you mentioned 401ks, and I can't help but notice your book behind you, 401 Chaos, which I love, by the way. It makes me think of maybe some misconceptions that you've heard along the way of value investing. You've taught so many people through the years about investing. What are some common misconceptions about value investing that you've encountered, and how can investors avoid these pitfalls?
Well, the first one is, there's often a saying says you get what you pay for. So just because a price is low doesn't make it a bargain. And I'd say that's the number one thing I would say about value investing is just because the price goes down doesn't guarantee you're getting, price in and of itself means nothing. If I say, hey, Dell, I've got a deal, it's $1 million. That doesn't mean anything to you because you don't know what you are getting. And so price. People get obsessed with price and they think they can learn something from a price. I have to know what I'm getting. And so, number one is chasing price alone. That's a big mistake. And then number two is not knowing how to analyze what you're getting. It's pretty easy to go and thump a watermelon or, buy a peach or whatever, get some nice organic, green onions and go home and make yourself your Mongolian beef or whatever, all that good stuff, making you hungry. All that good stuff is easy to do because I can touch, feel it. I know what a good looking orange looks like. I know, what a bunch of grapes should look like. But people don't know what investments look like because they haven't learned to read financial statements. And so by looking into the financial statement and going through those numbers, that's when it reveals. So if you buy a stock without doing what we call a fundamental analysis, without doing that analysis, and you don't know how to do the analysis, that's the number one mistake you can make is, NVIDIA's price, it's low, let's buy it. NVIDIA's price, it's high, let's buy it. Or it's higher, let's sell it. Making decisions based on the price alone makes absolutely no sense to me because I don't know what I'm getting. Hey, Dell, I have something for you. It's $10,000. Do you want to buy it? Do you want to buy this thing? The pronoun needs an antecedent, so I know what I'm getting.
100%. What about going back to the fundamentals? What would be the three things, as you bring up financial statements? What would be maybe three things that you could touch on with this? This is what I need to look for. This is what I need to look for. This is what I need to look for when determining a good value investment.
Yeah. I think if we looked at three things and you only gave me three and you said, Andy, you can't do a full analysis. You only give me three. I'd look at probably PEG because it has three really great things. It has the price, so I know what I'm paying. It has the earnings, so I know what I'm getting because that's called the bottom line. Literally, that's called the bottom line. Earnings is all the scrap, bottom line. There's the earnings. And then third, it has growth. And so not only do I get to see what I'm getting, I'm also purchasing a company that's trending. I have a friend that's looking at buying a company and he's trying to decide, is it trending down or is it trending up, right? I'm not just getting a company, I'm getting a company that's either growing or I'm getting a company that's either shrinking. And so again, that is a huge deal in knowing what I'm getting. What all those ratios, but there's three right there: price, earnings, growth. And if you go to Warren Buffett's mentor, Benjamin Graham, here's a misconception. Maybe I can get this in before the break, or maybe we ought to do the break. Should we do a teaser? Like when we come back, we've talked about what it is. When we come back, maybe we ought to talk about how to do it. And we can talk about Benjamin Graham's formula and tear that thing apart a little bit and see what Warren Buffett's mentor had to say. Is that a good teaser? I don't know.
I think that's a great teaser. So when we return, Andy will get into all of that and more. So stay tuned. You're not going to want to miss that. All right.
Fantastic.
Very good. All right.
It's helped me a lot. The simplicity has really gotten me on the track to where I enjoy the learning as well as it's really solidifying in my mind. And like, they're not just trying to sell you something, they really care about the people that are in the course, and they really do care about you and your personal goals, and what you want to do is to help you and your family and whatever your goals are in life through that. So it's really been great.
Welcome back to this episode of Rich Dad Stockcast. Again, our topic is the fundamentals of value investing, how to build a monthly cash flow machine. Now, before we get back to Andy, remember to like, subscribe, and leave your comments below. Your feedback helps us to bring you more of the content that you want to hear. And don't forget to visit stockcastbonus.com for free access to valuable educational resources to boost your financial knowledge. All right, so let's get back to our guest, Andy Tanner. Andy, you left us on an edge here. Like, let's explore that a little bit more. Like, lay it into us. How do we do this stuff?
Well, we were talking about Benjamin Graham, who, Buffett, he went, I think it was Columbia, and he enrolled because he wanted to learn from Ben Graham. He didn't even know he was still alive, I guess. And he read his book. He shows up and he goes to class, and it's a great story. But Ben Graham, he wrote a couple of books. He wrote one about that thick called Securities Analysis, which, you can throw out in front of a moving bus and the bus would get the worst end of the deal. It's a doorstop book, man. It's a heavy deal. But then he wrote one I really love I read it once a year, called, just do encore reading in it, called The Intelligent Investor. And it's a lot about temperament, really. It's about doing things smart and not emotionally. It's about your temperament. But in that book, Graham gave an example of what a value formula would be. How do you find value? Now, people didn't understand that this was not Ben Graham's personal value. He's just saying, here's an example of what a good one might look like, and what is kind of a generic textbook idea. But a lot of guys use it. They say, oh, good enough for me, I'll use it. And it had those elements we talked about. It had price, it had earnings, and it had a growth rate in it, and it was a glorified peg. Really had a lot of other things, some interest rate stuff thrown in there, and some other things. But the overall concept, I learned so much in my years traveling with Robert Kim, and Kenny McElroy is off the chart. I mean, that dude, he is way smart. And you would not approach real estate any different. So if I could drive home the concept of the big picture, if I get a brochure from Kenny for one of his projects, one of the things I'm really interested in is population growth. I'm going to have an asset, and I'm buying an area. So what am I getting? Am I getting an area? What am I receiving? Am I getting an area that's declining in population? Or am I getting an area that's increasing in population? Am I getting an area where a factory is being shut down and jobs are leaving? Or am I getting an area what am I getting? Well, I'm getting this lot that's right next to this new Micron plant, this new Adobe, they're coming in, and the jobs are coming. So understanding what you get in relationship to what you pay is value investing. And how it's done is through comparison, apples to apples. Now, in the stock market, how do you do this? How do you actually learn it? Well, first of all, I'll give us a plug, as I always do. The part of the purpose of the Stockcast is to introduce people to us. And as you said at the top of the show, this is for people. We are here for people who are serious about financial education. So the first step in actually doing it is go to stockcastbonus.com. We have resources. We'll let people spend an entire day with us, and they'll go, they can do this for no charge and kind of see what it's about. But you start to learn, like, for example, how to do a search. I can list criteria of what I want to receive, the value that I want. What dividend am I getting? I can say, well, I only want to look at dividends that pay 4% or better, or 3% or better to start with. Or is it optional, or is it shortable? What am I getting? And so once you decide what you want to get, you can put those in a computer. It helps with, you say, go fetch. you get a list of all these choices. And then you say, well, what does this one cost? What does this one cost? What does this one cost? And you go shopping. That's how it's done, specific criteria. But I can't I don't try to convince people. I guess I'm an education advocate, but I'm not an education, salesman, in that if someone wants to be dumb, I'm not going to try and convince them to be smart, because you're talking with someone that it's hopeless, right? If someone says, no, I want to be ignorant, there's nothing I can do to help the person. But once the person says, yeah, I want to learn, oh my gosh, the things they can learn. And so value investing is a core, fundamental, bottom line deal. And how it's done is criteria, searches, and most of all, the first step is just learning what to look for, learning what to see, and how to see the same way you go to the grocery store. Is this fresh or is it rancid, right? Is this firm or is it crisp? Knowing what to look for. That watermelon, is that vibration just right or not? Knowing what to look for makes me a better consumer. Well, knowing what to look for makes me a better investor as well. So it's pretty fun stuff to have that confidence knowing. So
you're absolutely right. And I think there's a lot of people that are out there that, hope is their strategy for retirement. And, you've always said hope isn't a good strategy for retirement.
Yeah.
What about, as we think about building our cash flow machine through value investing, what are some steps that an investor can use to create that cash flow machine?
Yeah, so this all has to fit within the context of your personal financial blueprint, right? And for most people, if you've read the book Rich Dad, Poor Dad, just a life-changing book, the most important page that I found that changed my life, where that book really set the hook for me, was looking at the financial statement. And it said, look, once you buy enough of these assets that your passive income is larger than expenses, that's your freedom day. And I always pictured financial freedom as being, I got $1 zillion and I get up in the morning and put on some skis and I ski down a pile of cash. And I have friends that do that, right? It takes them 5 minutes to ski down off their cash every morning. But actually, no, financial freedom, Kim and Robert were making about $10,000 a month from their rental properties, and they were financially free, and it changed their whole lives. 10 grand a month. That's where that. Now they're obviously in a different place, but really getting out of the rat race for them, I asked them, it's about 10 grand a month. So when you look at these cash machines, if you get a rental, you get a rental house that pays you $1,000 a month. You get another one that can get you up to $300-400 a month. You get another one's $500. And as they grow over time, they get paid off and the rents get higher and the payment's the same. And it's the same with stocks. You buy your Exxon Mobil at, $40, and now it's at 106, and the dividends going up every year for 37 years in a row. These cash machines just start to pay off. But I'll tell you when you buy them, and I would absolutely pound my fist on the table and say, I told you so. But when you have a COVID or a 2008, I'll tell you why the stock market and the real estate market are beautiful markets. Warren Buffett, listen, everybody, I've said this 1,000 times. I'll keep saying it until people get it in their head. Warren Buffett calls this the shooting the fish in a barrel experience. Like, the bargains are so good, it's shooting fish in a barrel. And what that metaphor, that shooting fish in a barrel, means you can't miss. That's what shooting fish in a barrel means. It's just really hard to miss when the fish are right there, bang, bang, bang. What happens is this, and it's a glorious thing about stocks and real estate. Distress freaks people out, and they'll give away the value for nothing. They will panic. It's the pawn shop. Some dude needs cash. He's freaked out, and he goes to the pawn shop and he gives the thing away for nothing. So you get this great value. And what happens is in real estate, we call it a distressed property. There's no such thing. It's a distressed person. They just got a divorce and they just want out. And you're giving them a great service, because value is in the eye of the beholder. That house to them is not valuable, because all it is a fight. And they just want to get it frickin' done, right? That's a big one. Another one is moving, and gets a job that pays, double his salary in Dallas, and he lives in San Francisco, right? I got to get this thing sold. My house in Dallas is going to be much cheaper. I got to get this thing sold. It's going to be great, right? So all this type of stuff, it's just the value is massive. So you think about COVID. Look, we had a virus floating around. Everyone's freaked out, right? And the stock market goes down 30%. So you're 30% off. 30% off. You think Apple's going to succumb to a coronavirus? You think Nvidia, you think ExxonMobil, you think, pick them, Berkshire Hathaway. You think all these are going to succumb and they're going to get killed? Coca-Cola was started in the 1800s. I think it's post-Civil War. At least it's post-Civil War. But World War I couldn't kill it. World War II couldn't kill it. Vietnam War couldn't kill it. Gulf War couldn't kill it. 9/11 couldn't kill it. Pandemic couldn't kill it because they sell 8 billion drinks a day with caffeine and we're addicted, right? So the value comes in the crash. That's why people are like, why are you guys always excited about the idea of a crash? Because it's Black Friday, Black Swan's the same dang thing to me. So when they panic and prices drop, that's when you're going to find your value. Shooting fish in a barrel. And yet people are so freaked out. Why? Because they're focused on what they pay and the price going down. Oh, what if I buy this and the price goes down further? Who cares? What you're getting is amazing. What if I sold you a Ferrari for half price? And there was a risk that the Ferrari might go down a little more because, maybe there's a lot of people that can buy them all of a sudden. So what? You got a Ferrari and you got a great price on it, right? Who cares? And if it's a cash flow machine, it's more important. If it's paying me, if I pay $1 for a machine, it gives me back $1. What do I care what the price is after that? I paid $1 and it's given me $1, and it'll do that for the rest of my life. I don't care. I'm not selling that cash machine. Said nobody. I can't, old Greg Arthur, he used to host the show. He says, Andy, can you go an episode without a golden goose analogy? I don't think I can. Said nobody. I think I'll buy that golden goose because I think the price is going up. Said nobody. I'm going to buy the goose that lays the golden eggs because I'll bet I can sell it next week for more. I bet the price of that goose is going to go up. You're buying it for the eggs. You're buying it for the cash flow. What are you getting? A cash machine. So the idea of value investing, on the one hand, of finding a cash machine, and then once you get it, your job is to collect. Your job's then to call Tom Wheelwright and say, I got a tax problem. How do I fix this? That's your problem after that.
Well, that's a quality problem to have. Now, let me push back. Let me push back a little bit.
Do that.
I do love value investing so much. But why wouldn't I just go trade some options? Why wouldn't I do the short-term stuff? Why not do that as opposed to value investing?
I wouldn't tell anyone they couldn't. If you want to do that, go do it. People do it all the time. It's certainly a method, and I have friends that do it all the time. Now, there's pros and cons to that. If you are a day trader, right, and you're day trading, you have a job. Because if you stop day trading and you stop buying whole and selling high, you stop earning money. So it's the same as someone says, well, Andy, why would I get a rental house instead of being a house flipper? That's essentially the question you asked me.
Exactly.
Why buy these rental houses that flip houses? Look, I have two friends that both have billions of dollars under management. One's Kenny McElroy and one's Dan Merrill. Kenny doesn't often, but sometimes he'll do development. So what does that mean? Well, he takes a piece of ground and he takes a bunch of construction and he makes the thing better than it was when it was just a piece of ground. Okay. What Than will do is he'll take a piece of ground with some stuff already on it. He'll do a bunch of construction and make it better. So one is a developer, and another one might be what we call a rehabber, right? He's just going to rehabilitate, which means now the property can do what it couldn't do before. Well, Than has a property called CT Homes. They flip 100 houses a year. It's like a construction company. It's not that much different than, redevelopment and development is very similar. It's construction, it's raising value, it's raising NOI. Both of these guys have billions under management in their funds. Both of them do. But so you can make a ton of money flipping, you can take ton of money trading. But our preference for many of us is, I'd rather just rent and don't have to work as hard. My wife and I flipped a couple houses when we first started out, when we were first married. We made money on, we flipped, I think 2 or 3 of them, right at the same time before we had kids. And we made money on all of them. Now, I think I made about 25 cents an hour for the work I put in. So, look, if you want to put in the work and you want to keep doing that, knock yourself out. I'm not going to argue with that. But what lifestyle do you want? Options have one thing that a stock doesn't have. Options are like buying milk. It's got an expiration date, and you got to do something with it, and you got to get some value out of it, but it's limited. You can't live your life on milk. Gold has no expiration date, but it doesn't do anything, right? But a company and a real estate project, Bitcoin doesn't have an expiration date, but it doesn't do anything. So understanding what you're getting when you buy gold, you're not getting a cash machine. When you buy Bitcoin, you're not getting a cash machine. When you buy real estate, you're getting a cash machine. When you buy stocks, you're getting a cash machine. You're buying companies. And so, why not just do the other? I wouldn't dissuade anyone from doing it. Options expire, so you got to do what you're going to do with them before they expire. And I do both, right? I own stocks. I trade options. I invest in businesses. I trade the option contracts because they're going to go away. So, and I'm usually the dairy farmer. I'm usually the guy selling the milk because I know it's going to expire and people got to come back for more milk. So I have no problem with the guy that wants to trade those, but it's your choice. It's what your blueprint is about. Most people want a cash flow jack in the box. So there you go.
I think you're right. I love that. I just want to play devil's advocate there, but I might have to
fine.
say,
Yeah.
I might have to say this with all the food analogies. We might have to change this from Stockcast to Foodcast.
Hey, I'm not. This belly didn't get here without really. I earned it. Okay, not everyone can do this. I told Marcy says, "You're eating that whole ice cream there." I says, "Honey, this is a skill. There's not a lot of people who can do this." So anyway, but yeah, the food analogy is good stuff for sure. Hey, her dad, she just lost her dad recently. So that milk analogy is in honor of the great dairy farmer, right? So we'll salute that, big salute to America's dairymen.
Absolutely. I love it. Well,
all right.
That's
great
a wrap.
Stuff, though.
Absolutely. Well, that's a wrap for today's episode of Rich Dad Stockcast. We hope you found our discussion on the fundamentals of value investing, how to build a monthly cash flow machine helpful. And a big thank you to Andy Tanner for sharing his expertise with us. Now, remember, whether you're just starting to save or nearing retirement, the key is to stay informed and educated. And speaking of education, don't forget to visit stockcastbonus.com for free resources that can help you on your financial journey. And if you've enjoyed today's episode, please make sure to like, subscribe, and leave us a comment. Your feedback helps us to improve and bring you more of what you want to hear. Share this podcast with your friends and family to help them to make better financial decisions too. Thanks for tuning in to Rich Dad Stockcast. Until next time, get smart, get invested, and get control of your financial future. I'm Denney, and we'll see you on the next episode.
This podcast is a presentation of Rich Dad Media Network.